Welcome to Miller Value Partners Live Quarterly for July 2025. I'm David Yazdan, and I'm joined by my colleagues, portfolio managers Bill Miller IV and Dan Lysik. We're excited to dive in and provide our market views, discuss some of the investment opportunities we've identified, and share insights that we hope will spark new ideas and conversations with you going forward. After we hear from Bill and Dan, per usual, we'll open it up to Q&A. If at any time you have a question, you can click on the Q&A icon at the bottom of your screen, type in your question, and then press submit. We'll address your questions at the end. So let's begin. We'll start with a short recap of our Q1 update in April to help highlight again how the moods of market participants can change drastically and quickly. We reminded our clients that volatility resulting from short-term policy uncertainty provides an opportunity for long-term investors. With history as our guide, these market-driven drawdowns should be viewed as gifts for value-oriented investors willing to be patient and contrarian. We also showed how significant intra-year drawdowns in the market, like the one we just experienced in March and April, happen often, even in strong performance years. Harnessing this volatility is a key component to our portfolio management edge, providing us with opportunities to enter, exit, or resize positions based on our estimate of their intrinsic value or embedded upside. We highlighted our concentration edge and the advantage of owning fewer investments than passive investment or passive index funds, or even typically some actively managed mutual funds. Constructing concentrated portfolios like the ones at Miller Value allows for deeper knowledge of the business, management teams, and the key drivers for value creation. As of quarter end, June 30, for Miller Value Partners Appreciation ETF, ticker MVPA, the fund's top 25 holdings represented over 85% of the fund's total portfolio. And Miller Income Fund, ticker LMCLX, the fund's top 25 holdings represented close to 90% of Miller Income Fund's total portfolio, again, as of June 30. We're reminded here that index funds are forced to own all of the constituents in their index, regardless of whether the business is trading at an attractive valuation, run by a quality management team, has viable growth runway, or any other precondition for a sound investment. So remember, when you're investing in an index, you're owning the good, the bad, and the ugly. This dispersion in outcomes of all constituents in an index, or said differently, the spread between winners and losers in an index tends to widen the smaller you go down the market cap spectrum. It's another reason why we believe that active managers like Miller Value, trained in bottom-up fundamental analysis and trafficking in small cap and mid cap securities, have an advantage over their passive competitors. We've posted our Q2 commentaries on our site. Go to millervalue.com and scroll down to the bottom of your homepage for links to our Q2 commentaries. In these commentaries and on this call, we'll discuss our market views, provide updates on specific holdings, and share some rare opportunities in certain sectors and market caps. Moving on to performance for the Miller Value funds, which were strong across the board for the quarter ending June 30. We'll start with Miller Value Partners Leverage ETF, ticker MVPL. After underperforming the S&P 500 index in Q1 of this year, MVPL had a strong second quarter, returning 19.66% for the quarter, while the S&P 500 returned 10.94% for Q2. MVPL's inception return, again, inception for MVPL was February 27th, 2024, so roughly 16 months ago. MVPL returned 25.76%, versus 17.73% for the S&P 500 index, again, for that 16-month period ending June 30. Now for Miller Value Partners Appreciation ETF, symbol MVPA, this fund had a strong Q2 as well, returning 10.27% versus 3.82% for its Morningstar category average, which is the US mid-cap value funds category. MVPA's since inception return, and again, its inception for MVPA was on January 30th of 2024, so roughly 17 months ago. MVPA returned 26.4% versus 9.11% for the Morningstar category, equating to an over 1,700 basis point outperformance for MVPA over the mid-cap value fund category for that 17-month period ending June 30. And finally, for Miller Income Fund, LMCLX is the ticker, and that's the ticker for the iShares. Miller Income Fund's one-year return through June 30 was 18.99%, and that ranks the fund in the top 1% of Morningstar category, which is the US moderately aggressive allocation category. And for the fund's trailing 5-year return through June 30, Miller Income returned an average annual 14.09% versus 10.41% for the category, ranking Miller Income's 5-year return in the top 5% of the category. We believe Miller Income Fund's process and ability to invest across the capital structure has provided the fund with a level of flexibility that's hard to replicate in any style box restricted strategy. Put simply, we can fish where the fish are. Later on, Bill will share more about his process for finding undervalued yield opportunities and how it's evolved over time, much to the benefit of Miller Income Fund shareholders. Now, before I hand it off to Bill, I should mention that Dan Lysik was interviewed last month by Capital Employed. In the interview, Dan provides a deep dive into the investment process and shares investment examples, including United Natural Foods, Neighbors Industries, and Quad Graphics. If you'd like a copy, I can email it to you. Please reach out to me at my email, which is dyazdan@millervalue.com. That's dyazdan@millervalue.com. Also, mark your calendars for Monday, July 28th, this coming Monday. Bill will be on CNBC's Closing Bell in the 3 p.m. hour. We don't have an exact time yet, but we will post it when we do on our LinkedIn and X profiles. So when we come back and visit, and we'll have that confirmed hopefully over the next few days. Now let's get to the meat of the call. In Bill's July commentary titled, "It Often Rhymes," he explores the swift recovery of equity markets following the sell-off, coinciding with a historic drop in the value of the US dollar and widening valuation spreads. All of this while non-sovereign stores of value, including gold and Bitcoin, continued their rise. So here's Bill with his market outlook and the opportunities he sees manifesting today. Bill?
Thanks, David, and thanks to everyone on the call for your time and attention and partnership. We truly do appreciate you. Today was a really auspicious day in the market for our call. Why do I say that? You had the biggest single-day move from the largest home builder in the United States since 2009. Why is that interesting? And why do I mention that? Well, because valuations can get way out of line sometimes, and they can discount realities that don't manifest, and stocks can trend and things can move in strange directions. And it's a pretty clear signal here from DR Horton going up 16 and change % in one day, ending at the high on the day, that things are okay. Home builders, the home building industry is a big marginal driver of economic activity in the country. And so you had a pretty clear bell here that things are going to be okay on the economic front, and arguably better than a lot of people think, and a lot of what valuation is discounting. And so I want to transition with that idea to my recent investor letter that David mentioned, called It Off and Rhymes. It's available on millervalue.com. Now, and in the note, we highlight the extreme relative performance, large cap growth versus small cap value discrepancy, and how it continued again, has so year to date, at least prior to today, heading into the end of the first 2 quarters, large cap growth was up north of 6%, while small cap value as a whole was down 3%. And that's a persistent dynamic that's gone on for the better part of 2 decades since the financial crisis. I was recently at one of our boutique research providers' idea days. It was a fabulous day. He mentioned his opinion that SMID caps are an inferior asset class to large cap growth, or to large cap, growth generally speaking. And so to me, nothing says capitulation like a statement like that. The other side of kind of this long dynamic of large cap growth outperforming small cap value is actually valuations there are getting pretty stretched. And that's one of the things we address in that note. If you look at large cap growth now, it trades at a 21 times EV to EBITDA multiple. And if you invert that multiple and you look at the cash flow yield over the total capital in the market, you get about a 4.7%, 4.76% rate, which is very, very little premium at all to the 10-year government bond at 4.3. And if you look at that spread over time, the last time that it was that stretched and that large cap growth effectively gave you 0 returns over what's a guaranteed return for those who buy and hold the 10-year bond to maturity. The last time that happened was 1999. And what happened after that? Well, the tech bubble burst, and large cap growth went on to underperform small cap small cap value for the next 5 or 6 years by a huge margin. So from the end of 1999 to the end of 2006, people forget this, the Russell 2000 value index went up by over 185%, while the large cap growth index lost almost 30%. That's 2,100 bips of annualized performance gap over 7 years. It's massive. And so people forget that this can happen just given what has happened for the past few decades. And I think now is a really interesting time to be looking at small cap value and increasing that as a percentage of your overall portfolio. So SMID cap value. What else happened during the first half of 25? Well, the dollar lost 10.7% of its value over 6 consecutive monthly drops on a trade weighted basis. So that's the worst start to a year for the dollar since 1973, shortly after it began floating. And if you just look at the history of economic and macro dynamics, weaker dollar and inflation tend to correlate with higher nominal economic growth, which is all of what you're seeing now, higher structural interest rate environment, all of which means better upside fundamental surprises to small cap companies that are more economically sensitive and cyclical, especially in light of that valuation gap we just mentioned. So when people start to see the surprises coming through and what's going on in some of the small cap land, the world's not as bad as they thought, I think you're going to see more days like today. I think it was roughly 150 bips of outperformance today for small cap value versus large cap growth. And so we're really optimistic about the way we're positioned because that's what we own. And I'm going to turn it over to Dan now to talk more about the valuation landscape and why we are so excited about it, just looking through the data.
Great. Thanks, Bill. We actually put together some slides that I think to further kind of give you maybe a visual of some of the bullet points that David and also Bill had just mentioned. This one that you're looking at, the first slide here, this is the U.S. Uncertainty Index. We introduced this last call. So this is back in the last 25 years. And if you go back and look, you can see 2020 was the spike of COVID, which brought that index to 500, which was a new high at that point. And so recently tariffs at the end of April was actually a new high of in excess of 700, more than 50% above the COVID 2020 levels. So while tariff fears peaking in April, you can see how the index is actually, the uncertainty index has quickly started to kind of reverse course. And while we still might see some near-term, kind of step up in uncertainty levels around tariffs, it's similar to post-COVID with the initial rollout of COVID and then other variants and infections that came, after that. We think anything that likely surfaces would be more short-term in nature. So the long-term trend continues to likely see the index return to its historical average. And it's worth kind of mentioning, you're going to hear this theme as we go through some of these charts. Market leadership in 2020, initially coming off the last spike there, you had a rotation of large cap growth companies that were beneficiaries from work from home. Leadership past couple of months, as Bill mentioned, was led by long duration equities and then AI related tech companies. So again, we would expect broadening out, lower market cap, lower valuation equities. The setup is actually looking pretty strong for the next couple of years. So on the next slide, we had 3 charts kind of lined up, and I want to walk you kind of quickly through these. But the first one that's on the left-hand side, these are all long duration equities to show you how crowded the market continues to be. The chart on the left is based on price to sales. Most expensive quintile is the top dark line that you see. And at the quarter end, it was near 12 times revenue. That's close to 21's peak. That's more than 30% higher than 2000's peak levels. And as you look to the right, what you can see is that here we're kind of highlighting price to sales by decile. 2010 is the darker line, and today would be the lighter line. And so again, as you move to the right, longest duration deciles, you see obviously the multiple expansions taking place over the last 15 years. The highest quintile going from 8 times to now 17 times, more than doubling. And so again, what this has done is the lower right-hand chart captures this, is if you look at the percent of the S&P 500 by market cap that has greater than 10 times on a price to sales basis, that is up now in excess of 25%. And the chart you're looking at is for the past 75 years. It's rare to see this be more than 10% of the index weight. And there's been tons of studies that show how long-term returns from high valuation equities in excess of 10 times revenue underperform over the long term. During the dot-com peak, you got up to 25% of the index. In 2021, we approached 25% before we saw a sharp pullback taking place late 21 to 22. And so at quarter end, we're now again approaching 2000s levels. And if you were to take we don't have the chart here, Russell 1000 Growth Index has more than 55% of its weighting in companies with price to sales over 10 times. So the greater weighting in long duration equities is a growing risk, we believe, in passive indexes. And it gets back to how David highlighted in the intro. We don't have to own companies with high expectations, high valuations. We think those are potential risk for actual loss of money over a period of time. So we believe a potential kind of creation of a headwind for passive indexing when you look out over the next couple of years. On the next slide, we have 2 quick charts to briefly highlight the concentration, which has been driven by mega cap growth that Bill had mentioned. The chart on the left highlights the S&P 500 weight of the top 5 Russell 1000 Growth Index and the Russell 1000 Value Index. Not surprising, the dark line is the Growth Index, which is approaching 30% of the S&P 500 weight. And again, that's an all-time high. When you look at the Value Index, you're actually back at a 50-year low, which is close to 6%. And it's important to also look at the magnitude of this concentration cycle from 10% to 30% since 2012. You go back to the late 90s, you went from 10% to only 18%. So much greater concentration cycle in the past couple of years and going back even to the late 90s. The chart on the right looks again at that top 5 weighting in the Russell 1000 Growth Index. And the light line is Russell 1000 Value versus Russell 1000 Growth on price. And you can see it's important, I think, to look at the 2000 time period when value troughed underperforming growth. That's the same time period where the top 5 concentration in the S&P 500 from the growth index peaked. Again, the amount of growth exposure from what was happening, concentration in the growth index worked its way into the S&P 500. And then that kicked off an outperformance of value pretty dramatically over from that time period forward. We can see what's been transpiring since that time period. Obviously, growth has done really well. Value's lagged. And given the extreme outcomes that we're seeing today, we think the setup is for value to do much better over the next couple of years. On the next slide, we're going to briefly kind of highlight small cap value and compare it to large cap price to sales basis. You can see how price to sales of looking at small cap versus large cap was at a 40% premium in 2000 time period. And then a lot of folks forget that went from a 40% premium to a 70% discount within 6 years. If we look at where we're sitting today, we're actually well in excess 40% premium, past the 2021 peak, now up to a 70% premium. So again, we think large cap value, which has done well, as a significant amount of valuation expansion has taken place. And we think the setup here is for small cap value to do incredibly well. The chart on the right highlights exactly what Bill just laid out. And you can see how small cap values led the market 2000, 2006, and large cap growth had negative returns for 6 straight years. On the next slide, we look at the Russell 2000 value market cap compared to the Russell 1000 index market cap. We're now more than 2 standard deviations below average. And again, so when we go back and even look at the 2000 time period, you only got to 1 standard deviation. Again, showing the extreme of how much small caps have lagged over the last couple of years. If you take the top 10 companies on the S&P 500, their combined market cap at the end of the quarter was 21 trillion. That's 7 times larger than the whole Russell 2000 market cap. So reallocating 1% from large cap from the top 10% would increase the Russell 2000 by more than 7%. So again, we think, again, as asset allocators start to look at the opportunity set and we start seeing small cap doing better, we think that continues to see assets shift, which also would drive performance over time. And then on the right side, the last market chart that I had here was, even if you look at the last 15 years that favor large caps, small caps have done really well coming out of drawdown time periods. So we've had now the 7th 20% plus drawdown if you look over the last 20 years. And if you take the low point out of those 6 drawdowns previously and you look forward 1 year, what you can find is actually mid-cap value average return now was 57% looking at a year from the trough. Small cap value was up 67% and micro value was up 74%. It's also, if you look close into the slide, you can see the strongest returns were post the 2020 drawdown, which again, if you think about the levels of uncertainty in the market, valuation spreads, market concentration, again, we would just highlight the fact that the return upside potential could be greater than what we've seen on average when you look at those 6 other time periods. The other thing we'd also just briefly highlight that we think are beneficiaries, which has changed, I think, over the last 12 months. One is starting again a potential interest rate cutting cycle, which would be favorable. If you look at consensus, relative earnings growth is stronger for value for small companies versus large companies over the next 12 to 18 months. Additional tax benefits have a greater impact from the new legislation on smaller companies, and deregulation affecting numerous industries also could favor smaller companies. And the last, kind of highlighter data point, rolling 10-year returns, large cap versus small cap value is at a 90-year trough. That chart is actually on the website in our quarterly letter, so you can take a look at that. So again, we think it's a favorable multi-year cycle horizon, we think, for small cap value that's coming up. On the next slide, before we get into stock pick for this quarter, I just want to briefly cover last quarter's picks, a couple quick comments. We're seeing data points for increased market volatility has caused an increased demand in fixed and variable annuities. This is obviously similar to prior time periods. It's very favorable for Jackson Financial, symbol JXN, $88 a share, range attractive, near 20% plus earnings yield, market less than book value, 3.5% dividend yield, as well as Lincoln Financial, symbol LNC, priced at $34, has a sizable annuity business at 25% earnings yield, greater than a 5% dividend yield. And then Geld Wind, symbol JELD, closed today up strongly with housing related, $4.80 a share. Again, we have a new management team undertaking multi-year transformation and right-sizing their manufacturing distribution footprint. So while weaker housing market has been overshadowing their transformation progress, 350 million of fixed costs have been removed. Companies positioned for very attractive incremental margins as we see the housing market recover over the next year, 2 years. And incremental cost reductions also, we think, help the profit margins stabilize and see improvement later this year into next year. The shares look mispriced. Market cap is below normalized EBITDA. So that would be 2 times EV to EBITDA on a normalized basis. And then the shares are also a deep discount to book value. In the past, we talked about how Gray Television's long-dated debt was mispriced. If we look at JELD-WEN, they have 500 million of liquidity, limited near-term maturities, and we believe their 2032 debt is very attractive, yielding 12% annualized. And then, so the chart for this quarter, I want to highlight, first, if you look at the energy sector in general, in our opinion, it's under-owned, low market expectations, and attractively priced. The pie chart on the left shows the economic sector weights of the S&P 500. Energy sector closed at 3% near all-time lows. Not surprising, last seen in 2020. However, the sector's earnings contribution would be more, close to 2 to 3x what the sector weight is today. Meanwhile, the technology sector in the quarter above 33%. The all-time peak is March of 2000 at 34%. And the sector had end of the quarter a forward price to earnings multiple of 32 times, price to cash flow multiple over 30 times. Again, very high embedded expectations the next couple of years. The bullets on the right, when we walk through, we believe energy prices during the first half of the year were discounting excess supply, recession fears, but global demand has remained strong. The last couple of months have been well ahead of consensus, and global supply is seeing less contribution from non-OPEC countries. Parts of Russia and Iran still remain offline, and we see a nice ongoing variant with where the market expectations sit for the next 12 months. It's interesting to note, since OPEC Plus has started production increases, oil prices have actually increased by more than $10 a barrel. So demand has actually stayed strong. We think supply demand is a lot tighter than the market expects. And then the next slide and last one, we just would highlight one company within the space, while we own also others that we would mention, which is Cord Energy, Technic, FTMI. We're hiding here also Neighbors Industries, symbols MBR, price at $31 a share. Neighbors is an energy service company. It's undertaken a multi-year transformation. It's focused on the leading technology, 450 patents, developing drilling automation robotics, not only on their rigs, but third-party rigs. They did a recent acquisition, which takes that business segment, which is very high free cash generating with low capital intensity, 90% free cash flow conversion. It doubles that in size. So we think that accelerates the transformation. And then these drilling solutions, as they become a larger part of the company, should drive overall improvement free cash flow in the next couple of years. The chart that we are looking at on the right are the business segments for Neighbors, are currently trading a significant discount to publicly traded companies. And we believe Neighbors long-term, the normalized EBITDA could be closer to 1.5 billion. And we also see the company having the ability to reduce debt by over $1 billion in the next 5 years. So if you look at peer valuation multiples for each of the segments, the enterprise value, in our opinion, should be multiples higher than where Neighbors' current market cap today is, which is actually, below 500 million. So with that, I'll turn the call back to Bill.
Thanks, Dan, for that information. I just wanted to talk a little bit more about the income fund and also give you a little higher data-driven view of what you're getting when you buy the income fund versus MVPA, and just talk about how the process has changed. So that David has mentioned that the performance numbers are shaping up. And one of the things he asked me heading into the call was, is there anything that's changed about the portfolio management process over the past 10 years? And I get the answer would be, I'd certainly hope so, because I certainly hope I learned something over this 10 years. And then we went back and looked at the actual data, and the answer was yes, a lot has changed over those 10 years. So even though there's more assets in the strategy and it's bigger today, it's far more concentrated than it's ever been. So we only have 38 holdings in the fund today versus 61 10 years ago. The weight of the top 5 holdings was 19% then, it's 28% today. Top 10 is half of the portfolio today versus a third back then. The weight of the top 20 then was 58% and 79% today. So we have a much more concentrated portfolio. I think we're using our flexibility to focus on names that we have a much higher level of conviction in, and that's worked out really well. Also, if you look back at what the portfolio looked like 10 years ago, we had a bunch of BDCs in them, which have that external fee grind, and we thought we would overcome that. It's debatable. And we also had a lot of mortgage REITs, and the math on mortgage REITs certainly, hasn't worked over a long period of time. We don't own any mortgage REITs anymore. We're doing the individual security selection across the entire portfolio. We shouldn't be paying other people to do that. So that's changed a lot. I think that's helped the portfolio, but what's really helped it again is the concentration, using our knowledge and experience to focus on stuff that we think is a lot more compelling. So that's how the income funds change. I also think it's a really interesting fund to own today for the simple reason that the yield on the S&P 500 just hit a 20-year low, the dividend yield. And so you're getting a huge spread to that if you buy this fund. You're looking at roughly a 6% current yield on the last dividend. It's the highest dividend we paid in a quarter, I think, in 3+ years. And we're optimistic about that level of yield moving forward. The way we think about it is we want to outperform the yield level over the long term. So if we're buying undervalued securities and we get the overall landscape right, and we have a 6% yield and we get some appreciation on top of that, that's what we're hoping for. And obviously some environments work better than others. I would go back to the past decade when the strategy was not as effective. And I go back to something I said in a previous investment letter, which is in a world that's awash in capital, things that require a lot of it aren't valued all that highly. And so if you look at what happened over the past decade, the world was awash in capital. There was no real, it had no required rate of return when bonds were at, the 10-year was bouncing between 1.5 and 3%. And so now we've moved to a much different structural environment where capital actually has a cost. And so things that kick off yield tend to be much more capital intensive than the long duration equities that we talked about earlier. And so this environment's much more conducive to a compelling return than potentially the last one was. So I don't want to sit here and say, yeah, the numbers are shaping up because we're amazing. The reality is there's certain environments that work better for certain strategies, and this environment is better for this strategy than the one we saw the last decade. So that's why we're optimistic about the income fund. I'm going to talk a little bit about the high-level characteristics across the funds from a valuation perspective. The income fund is going to be more value-y, and the MVPA is going to be more GARP-y. So the income fund trades at roughly 9.4 times as a portfolio free cash flow, which is a 73% discount to the S&P, which trades at 36 times free cash flow. Income funds EV to EBITDA multiples 5.7 times versus the market at 16.7 times. That's a 66% discount. Trades at a 70% discount on EV to sales and a 72% discount on price to earnings. So the income fund trades at roughly 7.3 times earnings versus the market at 26 times. You're going to get bonds in the income fund. So we do have approximately 13 or 14% in bonds at the moment. That's changed over the years. So when we launched the fund, we were pretty much all bonds because we thought that's where the best risk-adjusted returns are. That's come way down. Bonds have not done as well. This has not been a good environment for them. So we've been able to use that flexibility to buy things that we think have more upside. Going back to, I think David mentioned flexibility point. That's one way we've been able to use it in the income fund. So the income fund, the MVPA is also going to trade a little higher multiple. It's going to be a little growthier. Price to free cash flow on that, though, is still a meaningful discount to the S&P. 13 times free cash flow versus 36 times, again, a 63% discount. And if you look on a price to sales discount or basis, it's roughly an 80% discount to the S&P at 0.7 times sales versus 3.3 times sales for the S&P. That's all trailing 12-month basis. So that gives you a high-level flavor of what you're looking at in those two funds, which are sort of the stock pickers funds. One's a yield pickers fund, and the other one's just a stock pickers ETF. So that's kind of the high level overview of what's going on with those funds. We did see two big inflows yesterday and the last couple of days into MVPL, which was extremely encouraging. That's our smallest fund. It's also unique relative to our own pedigree and history, but it's one that we think has a very high probability of putting up good numbers over the long term. So we're optimistic about it, and we're glad to see that other people are as well. That's about it for my discussion of the funds, and I want to turn it back over here to David to kick off Q&A.
Great. Again, as a reminder, if you have a question, you can click on the Q&A icon at the bottom of your screen, type in your question, and then press submit. First question, Bill. Last week was crypto week. So can you give us an update on any changes or improvements to the Bitcoin regulatory environment?
Yes, hugely bullish, obviously, to have now a crypto-friendly administration running the show, if you're a crypto person. And so last week we had three big developments on the regulatory front. Three bills passed the House, all of which were very important. One was the Clarity Act, which gives clarity to what regulators should govern what types of tokens or blockchains. And so that's the Clarity Act. You had the Genius Act, which regulates stable coins and provides for frameworks around audits and backing of actual currency and securities. And then you also had the central bank digital currency nixing bill, so ruling that out. So all those passed the House. The one thing that I thought was really interesting about it, what you've seen over the past week or two is the Bitcoin dominance chart has gone down. It's fallen off after this regulatory clarity. And one of the reasons I actually think for that that's interesting is if you go through the Clarity Act and the way it was set up, you would think that they would regulate Bitcoin differently than Ethereum and some of these other blockchains that are out there just because of proof of stake versus proof of work. But when they actually set up the way they define what's a quote unquote decentralized blockchain, this legislation actually grandfathered in some of the things that have been out there for a while, like Ethereum, Solana, and other things like that. So they actually get effectively, if they had been launched today with this new regulation out there, they'd be regulated as securities. But the way this regulation is written, it allows them to effectively be grandfathered in and be regulated as commodities because at the moment, their blockchains are decentralized. So whether or not that continues, that kind of Ethereum pop and reversal remains to be seen. It's still my take that the overall protocol, the energy intensivity of Bitcoin, first mover advantage means that it will continue to win and eat the world of capital. So it has to do with the proof of stake or the proof of work protocol underlying Bitcoin instead of proof of stake, which underlies all of these other blockchains, which effectively means the more capital I have, the more power I have. That's proof of stake. Proof of work means if you're doing the verification of the blockchain and you're a miner and a node, you get to then decide the rules for the blockchain. And so that is what I think separates Bitcoin from everything else, along with its first mover and energy intensity and advantages. So still optimistic on that, but I think that sort of overview explains why you've seen a reversal in the Bitcoin dominance chart and a comeback in Ethereum and some of these other things and altcoins.
And I guess your Bitcoin related investments have been strategy and Semler. Is there any other exposure, or have you looked at any other way to participate besides those two holdings?
Yeah, I think just owning Bitcoin directly is generally speaking the best way to do it. But we have challenges with that as a mutual fund and buying these ETFs. But there are value-oriented ways to do it. So Semler trades at an attractive multiple. I think if you look at the creativity and what's going on with MicroStrategy, Michael Saylor just launched a new security yesterday, announced it, and it's launching this week. So we're constantly looking at all of those things and ways to participate in the space. We have historically landed on operating companies that we think are interesting valuations or have unique things about them, more so certainly than miners, which we have not bought and don't have any intention of buying. So that's how we've done it.
Great. A couple questions on Centene. It appears that you've sold out of MVPA. Could you discuss what led to the sale, and is it something worth revisiting at some point?
Yeah, I wish we'd sold Centene earlier. That's been our worst performing name in the fund by a long shot. So ideally, we would have sold that earlier. Management kept guidance kind of where it was for a long time, and then comes out and says we read a consultant report, and therefore now we don't think our guidance is any good, and we're pulling it. So I think the process there has been, we missed it. We took a tax loss on it. Do I question whether or not we sold at a time of peak uncertainty? Yes, I certainly question that. At the same time, it's not working, and it keeps going down every day almost. So technically, it's not in a good position. From a management alignment perspective, it probably had the least alignment of a lot of the other names we've owned. We think there's other good near-term opportunities there. But yeah, it's always worth revisiting the names that and think had good prospects and didn't. So we're certainly going to be watching that earnings call to see what happens and how the situation shapes up.
Okay, great. This question, which fund do you currently view as most opportunistic? And maybe that's something you can expand upon in terms of whether it's opportunistic and really what the goal of the fund might be to match what the client is looking to do in terms of exposure.
So MVPL is the easiest one, right? Because that's just going to be pure market exposure all the time. It's just either 1 times or 2 times. According to our quantitative model, it's mostly going to be 2 times. So that's just pure market exposure. MVPA is more of a stock pickers, GARPy, growth oriented. They're all opportunistic. So we're all constantly looking for good opportunities. We're constantly looking for things that we can wait and put big weights into. It's just a question of whether or not you value that yield component and want the debt in there, or if you're all about long-term capital appreciation. So that's how I think about the difference between those 3 particular funds.
Got it. Next question is a surprising lack of emerging market exposure. Any particular reason for this?
Yeah, so there's an additional question here. It looks like about the Russian holdings, which is a good one. Yeah, so we do lack EM exposure. That's a good way to put it. EM has also underperformed developed markets for extended periods of time. And obviously it's easy to highlight the EM exposure when you're seeing the dollar tank, and so EM looks great right now. But one of the reasons we do lack that EM exposure is, number one, we did have Russian securities which were effectively delisted, and we do still own them, to your point, which is a good observation. They're marked at 0 because we can't sell them, but there's always the chance that they come back. But again, that exposure that you mentioned with EM doing well and then small caps not doing as well, I don't know how often that's going to occur. I think if you continue to see dollar weakness, inflation, decent economic surprises, good economic performance, money printing, small cap value will do okay. And so I think you don't have that delisting risk with small cap value, and it tends to correlate with good EM performance. So that's why we don't have a lot of EM, but we do evaluate it.
Okay. Both Fannie and Freddie have moved lower over the past month. Is there any news moving the stocks? How do you feel about the current opportunity in the names?
Yeah, that's a good question. And good observation too. They popped on the news. I think it had to do with the board reconstitution, Pulte's comments on X, and it's just done nothing but go down since then. I still think from a valuation perspective, it's a really interesting opportunity, which is why they're still in MVPA. If you look at what they're likely worth under privatization scenario, it's still 3 to 4x where the stocks are today. Obviously, that's a binary outcome, and there's a lot of details that need to be worked out to figure out whether or not they actually get to that level of ownership, how much capital needs to go in, at what price, blah, 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 blah. But there's still a very good risk return skew there, which is why we still own them.
Okay. It seems like that is all the questions we have, so we can wrap it up here. That concludes today's Miller Value Partners Live Quarterly. Thank you all for your time and continued interest in Miller Value. Remember, you can follow us on X and LinkedIn and find content on our YouTube channel and on our website, millervalue.com, including, as mentioned, our recent commentaries from both Bill and Dan, as well as summary reports on many of the top holdings explaining what we own and why we own it. Again, we welcome your feedback in our effort to improve the Miller Value client experience, and we look forward to updating you again in October.